You've been doing everything right, saving every month, building your retirement account, watching the number go up, and the whole time, there's been a silent tax taking a percentage of every single dollar you have ever saved. You never voted for it, you never agreed to it, it's just been running in the background your entire life. It's called inflation, and most people have no idea what it's actually doing to their retirement. Here's a number that should stop you. At just 3% annual inflation, which is close to the United States historical average of approximately 3% per year over the last 50 years, 1 million in retirement savings loses roughly half of its purchasing power in 24 years. You didn't lose it to the market. You didn't lose it to bad decisions. You lost it to time. If you've been through this entire series, you've opened accounts, you know what to invest in, you know the order, you know your benchmarks, but there is one variable that every retirement plan in existence has to account for. And most people building their first investment system either don't know about it or push it aside because it sounds abstract. It is not abstract. By the end of this video, you'll understand exactly what inflation does to your money, why your index funds are actually your best defense against it, and one specific tool most people don't know exists that protects your savings directly from inflation. This is video number 7 of the Wealth Fundamentals series. We've covered why investing matters, the Roth IRA, index funds, investing your first 1,000, the order of accounts, and how much to save by age. Every one of those videos was building a system that works. But a system that doesn't account for inflation is a system with a hole in it. Well, today we close that hole. Inflation is a general increase in the price of goods and services over time. It is measured by the Consumer Price Index, or CPI, which is published monthly by the U.S. Bureau of Labor Statistics. The Federal Reserve, the central bank of the United States, has an official inflation target of 2% per year. Now that means the Fed considers 2% annual inflation to be healthy and normal. And historically, over the last 50 years, U.S. inflation has averaged closer to 3%, which sounds small, but here's why it isn't. Inflation compounds. Just like your investments compound upward, inflation compounds the erosion of your purchasing power downward. 3% sounds like almost nothing, but 3% every year for 24 years cuts the value of your money in half. That is not projection, that is the math. You can run it right now yourself at the Bureau of Labor Statistics Inflation Calculator. Link in the description. Let's make this real. $100 in the year 2000 has the same purchasing power as approximately $187 today, which means if you put $100 under your mattress in 2000 and pulled it out today, you didn't save $100, you saved $53. Because that's how much of 2000's purchasing power $100 still has in 2026. Now scale that to a retirement account. A couple who retired in 2010 with $1 million in savings would need approximately $1.48 million today just to have the same purchasing power. If they didn't account for inflation, they didn't have $1 million retirement. They had a shrinking one. Here's the version that hits closest to home. Imagine you hit your retirement savings target. You followed the benchmarks, you hit 10 extra salary, you retire with $750,000. Well, at 3% inflation, the purchasing power of that $750,000 is reduced to approximately $556,000 in just 10 years. Not from market crashes, not from bad investments, from a decade of inflation doing exactly what it always does. Here's the good news, and it's actually good news, not the fake kind. If you've been following this series, you are already doing the single most effective thing you can do to fight inflation. Retirement accounts invested in a diversified mix of assets, like index funds, have historically grown faster than inflation over the long term. The S&P 500's historical average return is approximately 10% per year. Inflation historically runs at approximately 3% per year. That 7% gap is called your real return, the growth above and beyond what inflation takes. That 7% is why a dollar invested at 25 is worth dramatically more at 65 than a dollar left in a savings account. The savings account earns 4 or 5% today. Inflation runs at 3%. Your real return? 1 or 2%. The index fund earns 10% historically. Inflation runs at 3%. Your real return? Approximately 7%. That gap is the entire argument for investing over saving. The difference isn't just normal returns, it's purchasing power that compounds. Quick pause. If the series is building something real for you, hit subscribe. The content we're building next is going to cover something most people don't start thinking about until it's too late. It drops Wednesday. Now let's get back to the video. Index funds are your primary defense against inflation. But there's a second tool, created by the US government specifically to protect savings from inflation, that most everyday investors have never heard of. It's called TIPS, Treasury Inflation Protected Securities. Here's how they work. TIPS are government bonds, meaning you're lending money to the US government. But unlike regular bonds, the principal value of a TIPS bond is adjusted with inflation. If inflation runs at 3% this year, your principal goes up by 3%. Your interest payment is calculated on that adjusted principal, which means when inflation rises, your return rises with it. When inflation falls, your principal adjusts back down. But you are always guaranteed to receive, at minimum, your original principal at maturity. The government designed this instrument specifically so that raising prices cannot erode the real value of your savings. So who is TIPS for? TIPS are not designed to replace index funds in a long-term investment portfolio. Index funds outperform TIPS over a long time horizon. That 10% versus 3% comparison holds over decades. TIPS are most useful in two specific scenarios. Scenario 1, you're within 5 to 10 years of retirement and shifting your portfolio toward more conservative holdings. TIPS provide inflation protection during the period when you can't afford to wait for markets to recover from a downturn. Scenario 2. You're building a small portion of your portfolio specifically hedged against a period of unusually high inflation, like what the US experienced from 2021 to 2023. Think of TIPS not as a replacement for your index fund, but as an inflation insurance for the portion of your portfolio that can't take a loss. Now here's the complete inflation defense built into the system we've been constructing across this entire series. It has 3 layers. Layer 1, your index funds in your Roth IRA and 401k. This is your primary inflation weapon. A diversified portfolio of low-cost index funds targeting the total U.S. market or the S&P 500 has historically returned approximately 10% per year, roughly 7 percentage points above the historical inflation rate. Every dollar you invest in these accounts is fighting inflation with compound growth. That's why we built the Roth IRA first, that's why index funds are the vehicle, and that's why the 15% savings rate matters. Layer 2. Your emergency fund and a high-yield savings account. The 3 to 6 months of expenses we covered in the first $1,000 video, that money should be in a high-yield savings account earning as close to or above the inflation rate as possible. Not a checking account, not under a mattress, a high-yield savings account. A high-yield savings account currently offering 3 to 5% APY in 2026 keeps your emergency cash close to inflation neutral while it waits. Layer 3. TIPS for the portion of your portfolio closest to retirement. As you age and shift holdings towards more conservative instruments, a portion of your bond allocation in TIPS specifically protects your principal from inflation during the window when you're preparing to actually use your money. Now the full system: index funds for long-term growth, high-yield savings for emergency funds, TIPS for the conservative portion of a maturing portfolio. That is a complete inflation-aware retirement savings system. One question for the comments: did you know that your index funds were already your best inflation hedge? Or did this video change how you think about what you're building? Drop it below. I read every comment. Here's where the Wealth Fundamentals series now stands. You know why to invest, you know what accounts to use, you know what to buy, you know the order, you know how much to save, and now you know how to protect what you're building from inflation. That is the real, complete, working financial system, built from nothing in 7 videos. The next video in this series goes somewhere we haven't been yet in Wealth Fundamentals. We've been talking about building wealth. The next video talks about something that quietly destroys it for most people without them ever realizing it's happening. It's one of the most requested topics in the comments across the entire series. That video drops next Wednesday. Subscribe so you don't miss it. If this series has been changing how you think about money, share this video with one person who still thinks keeping money in a savings account is a safe move. The safe move has been losing to inflation for 50 years. I'll see you guys Wednesday.